Portfolio Builder members, welcome to our Tuesday Trade Alert. It's October 22nd, and we pulled a nice profit on the Emerging Markets ETF this week. In fact, every position in our portfolio is up today. Let's start off with a quick review of the Tuesday trade, and then we'll take a look at the topical content over the last 12 hours, and then a review of our program. So last week we said it's a classic smash and grab by emerging markets. We saw the administration smashing China for the last 2 years, which is the biggest part of the emerging markets ETF, although it does span to South Korea, to a ton of countries. It's over 1,000 different stocks held in that emerging markets ETF. Now it does come with its own downsides, but the PE ratio is around 13 on emerging markets versus 17 here on the state side. And furthermore, the U.S. market is near all-time highs, and emerging markets will have to rise 20% just to get back to the current highs. Now, we did tell you guys to get into this on Monday. The profits I'm reporting are based on Tuesday, but if you did jump in on Monday, you did even better. Here was the trade alert last Tuesday. Sell the 43 call expiring this Friday, October 25th. It was a tiny credit, almost not worth doing, 6 cents. Then we bought to open the $41 put, same expiration, and that cost 14 cents. So we were able to set up this option caller for a debit of 8 cents. Now, again, the option caller in a bullish setup will be a drag on our returns. And so while we had 56 cents profit per share just from the underlying asset going from $41.91 to $42.47 for a 56-cent profit per share, we had to hand back 15 cents from our option caller. And again, we're happy to do that because our goal is to generate consistent income with extremely low drawdown. I'm very proud that we've never had a drawdown of over -1% in a single month. And so we'll take a look at our track record and the wild swings in return in October that we've had thus far and what's coming up. Now, if you had followed the alert Monday morning, you'd be up in another 30 cents a share. So what happened? Last Friday, phase one trade deal came out and caught us off guard. I thought that was the only deal that was potentially in the books, but the U.S. was being very aggressive that week. So I was worried we may have an equity sell-off and a nasty Trump tweet saying, hey, these Chinese are not willing to do anything in our favor. But they came out and had this great celebratory press conference after the market closed Friday. We sent out an immediate alert to you guys Friday evening saying, hey, phase one deal looks real. Time to go long equities. So we did that come Monday, and we've been doing very well. So let's take a look at what's going on in the portfolio really quick. Again, here's that emerging markets ETF. This group of companies sells products to 2/3 of the entire world, 4.46 billion people. Pretty crazy. And their growth rate is much faster than the U.S. Now, does that come with some downsides? Sure, but we'll take a look at that in a moment. Just to get back to that 2017 high, we have a 20% potential return on emerging markets ETF. Now, outside of the SPY and the QQQ and some rip-offs of those same products, emerging markets is by far the most highly traded and largest assets under management ETF in the world. So SPY, emerging markets, you have most likely the two most important ETFs that give you a broad basket of 1,500 companies that are automatically indexed and rotated based primarily on market cap. So what a wild month it has been. We started up 1.1% in the first week of October because of trade fears, because of stocks falling, and our TLT rocketing up higher. And we were a little overweight on the TLT because of the potential for trade talks to break down, not Friday a weekend ago, but 2 weeks ago when this phase one deal came out. So we switched gears after we had affirmed that there would be a trade deal rather than just being hopeful. And we've gone from a 1.1% return down to as low as -0.7 this week. And now, as of this recording, we're only down 0.3%. So I suspect we can go positive this month very soon. Why are we so bullish on equities? Well, we're dealing with low rates, quantitative easing, strong earnings, a strong economy, strong employment, lowering tax cuts, all sorts of very bullish things. And then to couple that, we have the potential for a phase one trade deal with China. So the date for that to keep in mind is November 15th. That's when we're hoping to see the two sign a deal. Our current allocation is 37% trading the SPY, Monday, Wednesday, Friday, taking advantage of 3 option expirations a week. Tuesday, we have a position in emerging markets, EEM, that's what we're trading today. We have a buy and hold position in precious metals, currently GDX, the gold miner ETF, not spot gold and not spot silver. And again, we like to be long gold when there's both quantitative easing and interest rates being lowered. Now, that's not just happening in the US, that's happening worldwide. And I suspect China will soon be increasing their credit lines as tensions start to slow down to close out the year with US-China. Now, that said, things could turn on a flip, and that's why we still have that huge 39% position in our bond portfolio. That's the TLT, which is taking advantage of interest rate changes on the long end of the Treasury market. Here's the new trade alert. And I apologize. That is sell to close as indicated, buy to close as indicated in step 1. And a mistake, it's not buy to open. So again, this is buy to close. You can close it for 4 cents. And your put option will expire worthless. It's only worth a penny today. Let it expire. Nobody wants it. The new trade alert is to sell to open the November 1st, 43.50. So we've moved up the strike 50 cents from last week. And to buy to open the 41.50 put. So we will not enjoy profits above 43.50 on emerging markets. But on the same note, we will not have to suffer the wrath of some sort of equity sell-off if the emerging markets ETF were to go below 41.50. That's our guaranteed price per share. And again, you want to have one of these option callers per 100 shares of emerging markets. So the net result is we're not going to get the maximum gain from this, but we're going to be able to dramatically control volatility. And with the stock bond portfolio, it's very hard to have a losing period of time. And even when we do have small amounts of drawdown, it usually lasts only a few days. As you've seen this week, it's only Tuesday, and we're already almost back to a big gain after watching the TLT really make it hard to have a profitable month. But the TLT is up significantly today, as are stocks. And that's why we're seeing the portfolio work its magic. So here's your risk graph. Just shows you the same information. You can see what your potential profit is as the emerging markets ETF travels higher. And on the same note, you can see the potential loss on the way down. So our maximum profit is $97 or 97 cents per share. And on the other side of the coin, our maximum risk is $1.03. So pretty even risk-reward ratio. I'm going to flip to here really quick, and then we'll look at the topical news. This presentation right here, this PowerPoint slideshow, simply shows you what we're doing, what our track record has been during different market conditions, and then we can also look at 2 different asset allocation recommendations based upon how much capital you have to put to work. So daily income trade alerts at noon Eastern. The predictability of this program is why we all get the same results and is so different than most trading advisories. Our target return is 1% a month, and we've only had a single losing month of negative 1% with an average of 1.5%. Down below, you can see the return our portfolio generated against the SPY. Now remember, we have a stock bond mixture, and the goal is to reduce volatility. So in December, you can see up here in the right-hand corner, this was up 6% and crashed to negative 14%. So that's actually a 20% move to the downside from top to bottom in terms of change of price on the SPY. Let me get this little thing out of our way so we can see the return. And you can see with the S&P 500 losing 20% in December, we returned 1%. That was primarily because of the TLT rocketing up, and then our put options protecting the SPY, reducing loss. Okay, so what happened next? Fed came in with the plunge protection team, they've been named, and market flew up. Okay, now between the low, which was negative 12, and the start of February, you can see the SPY rallied about 12%. Now, did we capture all 12%? No, we got 2.2%. So our covered call was limiting our potential profit on the SPY during this period of time. But for all we knew, this could have been the next financial crisis. This could have been another 2008 moment. We walked away with 2.2% return. Okay, look at February. We went up from February to March by a maximum of about 4%. Now, did we capture all of that gain? No, we got 1.7%. Look at March. Well, it went up about 2%, and we made 2.7%. The volatility in March drove the TLT up alongside the SPY. Okay, April. Pretty big rally. It was down as much as 3% relatively and flew up by the end of May to up 3%. So you could have, if you were masterfully calling the bottoms and calling the tops and some kind of magician swing trader who had inside information, 6% potential swing there, we made 1.2. Now, if you're a buy and hold investor, you've been through a roller coaster every 3 to 6 months, you're having a heart attack. Look at what happened in May. It went from up relative 3% to the bottom of June down 4%. That's a 7% swing to the downside. We walked away with 2.2%. Now in June, it swung from negative 3% relatively till July up 4%. So you could have pulled 7% profit in June. We made half of it, 3.2. Okay, July, same thing. We had this critical trade deal with the U.S. and China. I had no reason to believe there would be a positive outcome of that. As much as I'd like for it to be a positive outcome and for us to have easy trading to the upside, that's just not the case. We played it safe. We played it very safe in July. And the trade talks turned out that they said they had a great talk and they're going to make a deal. And it was, again, the same deal they said they're going to make just recently. So for 2 years, they've been saying they'd make deals, and that's been failing deal after deal after deal. So again, we will always play it safe, even though we know what the potential outcome could be. We want to play it safe. So in July, we lost 1%. Guess what? August, the tariffs did come just as predicted. Stock market fell approximately 6%, bounced up and down. We made 1.8%. Come September, we had a slow month. But what did September do? It returned zero. It flew up 5%, flew back down 5%. So in September, the S&P 500 gave you nothing. We gave you 0.3%. So that's our performance so far. We'll see how October squeaks out in the next 2 weeks. Let's talk about how to allocate your capital, make sure we're all following the instructions correctly. I'm going to give you two options. This is the allocation to follow the full system Monday through Friday. You're going to get the best results with this if you're looking for low volatility and consistency. Okay, because it's the most diverse. There's no overlap. There's no overlap between the SPY and the emerging market ETF. So it does give you a very, very strong portfolio, which we call weatherproof. You have 100 shares of the SPY, which you trade Monday, Wednesday, Friday. 200 shares of emerging markets traded on Tuesday. 200 shares of the TLT to trade on Thursday. And then a buy and hold position of 250 shares of GDX. Now, just a heads up, I like to buy and hold the precious metals because we have 3 of the magic ingredients right now. Number 1, interest rates are headed lower. Number 2, the central banks are printing money. They're buying up treasuries. The last ingredients for gold to rocket much higher is going to be fear. So depending on how the news flow comes out between now and November 15th, there's a small chance I might change our GDX position to be an even lot, so either 200 or 300, so that we can sell a call and buy a put and protect any kind of short-term downside on gold. Because in the big picture, we want to own gold most likely for the next 2 to 3 years. That's how long most likely this quantitative easing phase is going to last. But I believe a very positive trade deal out of November 15th could be a risk to our gold position. So we don't need to worry about that yet. We're a month out from that date, and it may not even happen at that date. Okay, so what if you have a little less time and less capital to get started? Here's a great setup for you. It has the same risk profile. You're putting your eggs in emerging markets instead of the S&P 500. And if there's a phase one trade deal, I do suspect this can greatly outperform the previous slide. Is it riskier? Sure. But keep in mind, we have that downside protection on emerging markets. I would never recommend this to someone in retirement without the puts. So keep in mind, this setup is safe because of the bond stock ratio plus the put options protecting to the downside. So this can be built for $35,000. It's the same weight ratios, relatively slightly overweight in equities. Still have a safe position in the bond portfolio, which will help offset any surprises to the downside. And we still have 10% in gold. So this costs $35,000 to build this portfolio. Target return, again, 1% or $350 a month. And you can scale this up. Just multiply each of these by how much capital you have. So if you had 100 grand, you wanted to follow this, you'd be doing 1,200 shares of emerging markets, 300 of TLT, and then 390 in GDX. Now, again, keep in mind, if I get fearful of potential downside risk that outweighs the upside potential, at least in the short term on GDX, I will round that up to a even lot so that we can sell a call option and buy a put. And again, with the gold position, I would love to hold this beyond a year so that we can get a lower tax rate. That's certainly something that I would love to do in this position. If we get assigned, that could be a cost, a potential risk in that regard. But I do see us being able to hold GDX for over a year to get the lower tax rate. So our simple 4 ETF portfolio is extremely diversified. 1,500 different securities that are automatically rebalanced for you. It's very hard to outperform these ETFs. Even the big players are buying these. We're talking Ray Dalio, Druckenmiller, all of them. They're all going to these big ETFs. Our goal is to generate income and safety, not growth or speculation. We're far more concerned about having low drawdown than trying to compete with any given index or any other individual's returns. So we're not in competition. Our goal is very clear. Low volatility, steady returns. If you follow our program, you'll simplify your holdings, reduce your risk, get better results with less work, and weather-proof your retirement portfolio. For every $300,000 invested, our goal is to generate a $3,000 per month profit. And if you do look in the description box, you can apply for our advisory program if you're new and haven't joined yet. So there's a link right there, and you can also call Dean. Okay, guys, in a minute here, we're going to switch over to our live stream content that's unique for the day, where we're going to take a look at all the top charts and top tweets from important people, from Trump to Nancy Pelosi, in just 1 minute. Now, I want to throw a quick shout out to people in the chat saying hello. We got Tom, Ron, welcome. How's it going, boys? Better week this week than that TLT sell-off last week, huh? And again, this is our disclaimer. If you want to read it in detail, you can visit the link, also in the description box. Okay, let's take a look at the content I've collected over the last 12 hours, and we'll get you guys on your way. China is now home to the world's largest number of unicorns. These are companies valued at over $1 billion. Now, the catch to this is it's private equity. Private equity is extremely overvalued. And the best example of this is WeWork, which went from a $40 billion valuation to $8 billion, and they just kicked the CEO out of the company. What a nightmare. Jeffrey, welcome. Thanks for saying hi in the chat box. But with that said, our emerging market ETF does give us exposure to a lot of these big tech companies. The main two that you want to have on your radar, which are the biggest positions in emerging markets, are Tencent and Alibaba. Now, Tencent is not just your average software company. They get pretty much unlimited capital from the government, and they go and buy out companies at record pace. They own Fortnite. They own Clash Royale. Those are the games we're playing here in the U.S. with all the kids. My son plays Fortnite. They're making insane money just buying out every tech app that they can get their hands on. And so China certainly has an interest in trying to control the phone app space. They have the only competition for, TikTok, which I believe is owned by ByteDance. But the bottom line is China is fueling these companies, and they're aggressively trying to go do mergers and acquisitions to grow their companies. Also, China is starting to relax some of their credit conditions once again. And so the biggest scare to this whole growth scene and this being bullish on stocks is if China slows down too much, that creates a ripple effect to all the emerging markets. And again, is what the fear is here in the U.S. But I believe with the deal currently in place, it's going to open up investment to China. It's going to peg up their currency, potentially, and maybe even get rid of the December tariffs. So if all of that comes into play, plus China starts printing some money and lowering all of their credit restrictions, we may have another leg on this bull market. And I'll also try to close out by what I see happening, not just this year and next year, but all the way out for the next 10 years, so you can see what the typical market cycles look like and how we can adapt as we start to move into these different conditions. Chinese Vice Foreign Minister will continue to resolutely safeguard national security and core interests. China will not allow other countries to undermine its security. So what they don't want to do is essentially allow auditors to get into their books. They have a very secretive system as to how they control their Communist Party, who has what power, and so you just have to trust their audits that they produce. So nobody does, but they can still see the sheer size, and we can see the accounting in terms of their trading partners. So that's our best bet as to trying to get a feel for that. And there's a lot of regulation happening in Congress right now that would potentially be negative for China. So we got to keep a look on that as well. This is funny. Not the Onion. Onion's a joke website. China accusing U.S. of fake economic growth. This is their Twitter communist handle. President Trump commented on China's economy. I actually suspect the economic growth in the U.S. is fake. Many investors told me they're worried the U.S. economic bubble will burst in the near future. China is building airports, high-speed railway quickly. What has the U.S. been building? Well, that's what's funny. China's certainly been building a lot of stuff, but you go to the railways and they're sending these empty rail cars to London at, 300 miles per hour. They've built something that looks like Star Trek just recently, this insane airport. It's impressive, but will it be used? There's interesting YouTube channels I like to watch. They're not financial. They have no bias to that. In fact, they had moved to China, married people, fell in love with the country, and things have turned against them in the last decade. And so they will go explore these massive cities, these ghost cities where they're just rotting away, they're cracking. There's some 50 ghost cities that are something similar to the size of New York, just sitting there rotting away. So China has a big problem. They cannot keep 1 billion people employed. And the second they stop doing that, their GDP numbers will crash. So what's the problem is they're building stuff that's not being utilized. And that's what happens with a state-planned economy. Now, on the side note, because they keep all their accounting secretive, they've been able to attract massive amounts of external investment through that Hong Kong exchange. That's why Hong Kong's so important to study right now, because that's their access to outside capital. And the second they get cut off of capital, I believe that's when we'll see the Lehman moment from China spread its way through the entire world. But we get the phase one deal. Part of it was talking about our banks coming in there and pumping more money into their economy. They'll certainly be able to keep these guys busy with the Belt and Road Initiative, which is some gigantic multi-trillion-dollar project to build the Belt and Road project. So they certainly can keep growing, but their big problem is it's a state-run enterprise, and that's not a best way to create useful things people actually use. This guy I've been following lately is very good. I'm not even sure. I was looking up information on all the central banks and the growth of their balance sheets. And this guy, Yardini Research, free newsletter. And it's extremely detailed daily update, but they do very interesting studies on the central banks, which shows they've just been taking turns. This entire bull market, these central banks have been taking turns printing money. Looks like it's U.S.'s turn, probably China next. And here's some highlights from his update this morning. The biggest risk to the longest economic expansion may be political rather than financial. Shiller's odd theory. And Schiller is the guy who predicted the dot-com bubble and the '08 bubble. His indicator is flashing red right now, but he's not predicting a crash this time. Schiller's odd theory, consumers want to take after Trump. Trump has given consumers more after-tax income with more uncertainty. Big increases in personal savings since Trump was elected president. No boom, no bust. Economic surprise index is moving up for the second half of the year. More upside surprises in U.S. than the Eurozone. Forward earnings better here than over there. And Schiller has this idea that the consumers are becoming more confident because of the lifestyle of the rich and famous president, which is interesting. Schiller coined the phrase irrational exuberance and correctly anticipated the bear market in 2000 because of his CAPE valuation ratio was too high. He also correctly predicted the bear market in home prices that led to the great financial crisis. His CAPE ratio is bearish again, yet he is bullish on the economy and the stock market. In our opinion, consumers are doing what they do best because their real disposable incomes are growing along with employment and real wages. So wages are growing at record speed. We're having a middle class boom. We're saving a lot of money on taxes. Plus, our government is creating huge deficits. So this is going to make these companies have very nice earnings. And so overall, we have a very nice setup to close out the year. Of course, the biggest question is, number one, if we did have an impeachment on Trump, which it's looking more and more likely that, at least at the House level, that may transpire, would we get a socialist like Elizabeth Warren in the office? If that becomes a real fear, I think we'll see a massive sell-off in stocks and bonds at the same time. It would be a disaster. Next thing they have been pointing out is the main attraction abroad is lower valuation multiples than in the U.S. On the other hand, it's hard to get excited about the fundamentals over there versus over here. And the main thing the U.S. has is just simply a much better rule of law. There's not rule of law in China. And there's no auditing, so you don't really know what's going on over there. So that's why we have a relatively small position in emerging markets, despite the much bigger potential upside. Missing ingredient, we would get much more excited about taking a portfolio trip abroad if commodity prices firmed and the dollar weakened. And that's what's happening right now and why we're seeing the nice rally in emerging markets, as well as U.S. stocks and gold. Okay, another risk we need to be fearful of And Dean actually sent me an article, which I think may be true. There's it's all rumors, who knows. Dollar liquidity turmoil returns with the first oversubscribed repo in a month. So there's something going on in the money markets. JP Morgan is rumored to be one of the main borrowers of this short-term repo. And so we're suspecting the Fed will come in and just put potentially $500 to $1 trillion in their balance sheet, clear off all the treasuries from the banks' balance sheets, and they're going to be dry powder. So if this happens, especially before the phase one deal occurs, we could have a massive stock rally. Now, on the other hand, if the phase one deal breaks apart, well, these banks still are in pure cash. They're getting bailed out by the Fed. There's no way they could get out of this tremendous position in treasuries they have without crashing the price of the bonds. So the rumor that Dean forwarded along was that have the banks essentially stopped loaning money to make this repo rate get out of control and force the Fed to come clear out their bank balance sheets. And the Fed is clearly in cahoots with all the big banks anyways. So I suspect, and we've been talking about this for months, that these banks will not offload these because there's no way they could sell them without crashing the market. They know that, and so they needed the Fed to come in, bail them out, get these treasuries off the balance sheet, and they're going to be back into cash. So they could drive the bond market much higher, or the stock market, depending on, I believe, what happens in this phase one deal that's leading up towards November 15th. This came out today, but relatively it's not a big deal. Home sales came down a little bit. With low rates, people are buying houses. A friend of mine who's a mortgage guy is on Instagram today or yesterday saying he can get you a house with $500 down now. That's how easy it is to get a mortgage. And he's been bragging about pulling 10 houses a week. And that's just here in little New Mexico. So we're definitely seeing a lot of economic improvements in the housing sector because of these low rates. In fact, in my city, there's all kinds of buildings popping up, which I hadn't seen for really since the last crash. This was very interesting drama yesterday. Tulsi Gabbard's Twitter account is growing rapidly, 50,000 new subscribers a day. She's the lady from Hawaii running for president on the Democratic side. And we had Hillary come out saying she's a Russian agent. What a joke. She's also the one who stabbed Bernie in the back last time around when he clearly had a lead on Hillary. And here's Bernie. Tulsi Gabbard has put her life on the line to defend this country. People can disagree on issues, but it is outrageous for anyone to suggest Tulsi is a foreign asset. Meanwhile, trying to get a read for what in earth is going on with this Ukraine deal. Trump was on Fox last night for a good 40 minutes talking about it. So just keeping a close eye on it. The Democrats are not letting anything happen. It's all focused on this impeachment inquiry. Some drama about trying to censure Schiff after he went on TV and fabricated a call transcript. Okay, let's take a look at some charts. Most everything is up today. Now, I know GDX says it's down, but it did gap open, so we actually are winning on that position too. But remember, GDX is most likely to really pop up and gap higher. And that's why we don't like to sell call options on it, and because it's not going to achieve that maximum return that we're trying to catch in the long run because of this quantitative easing happening all around the world. Now, what's our biggest fear for gold? If we got the phase one deal, would that cause the banks to stop printing money and lowering rates? Probably not, because we know there's phase two, phase three. So phase one, I don't think will change the picture for the bond market or the gold market substantially to the point where I would want to bail on those positions and just be 100% in on equities. So we do want to continue having that balance of defensive products in our portfolio against aggressive. So let's take a look at some charts. So here's the SPY. My target for the SPY with the phase one deal is to probably tap out. Now, I'm not saying right away. I think we're going to have trouble getting too much higher than 305 before the trade deal is actually occurring. After we get the phase one trade deal, I don't think it's outrageous for the SPY to travel to the 315 to 330 range. Now, after that, everybody's going to be wondering, well, what about IP theft? What about subsidizing key industries? And that's where most likely we're going to have a very hard time coming to an agreement with China, because that's their whole motto is tax the whole population, pool the money together for the greater cause, and then take over these industries that they think their people would do very well in, which is a lot of stuff they're trying to take over. So there's our look at the SPY, emerging markets. This is only the 1 year chart, but if you look at the 5 year chart, 52 was the 2017 high. And again, with the easing of pressure after 2 years of really beating down China, I think this ETF is ready to pop with a good trade deal. On the other side, if the opposite happens, this could tank probably down to the 30 range. So we're ready to play this either direction depending on how that phase one trade deal perks up. TLT is in a long-term bull market. We know what the most likely outcome is of the banks, of the central bank, and that's to slowly but surely drop interest rates as long as there's this slowdown in China and this uncertainty. What would turn this around really quickly? Inflation, of course. But right now we're dealing with super low inflation. Here's GDX. Look at the rally. In 2009 is when they started QE. Normally they don't do QE until a stock market crash has occurred. We're doing it at all-time highs. So we can see from 2009 through really 2011 was the big printing period. And the second that printing slowed down, you can see the gold miners sold off right away. So that's pretty much how we want to time GDX. Now, when would they stop printing? Well, that's going to be the second they get worried about inflation. That's when they'll stop printing and start raising rates. So we need to be ahead of that to know to get out of GDX. But I think we're at least a year or two away from that, if not longer. Dollar index softening, which is good for stocks, gold, emerging markets. Now, in our portfolio, instead of just being 10% gold, we've taken 2% and put 1% into Bitcoin, 1% into Ethereum. And if you want to do that, that's my recommendation. As the printing gets more aggressive and the uncertainty gets more scary, probably around phase two deal, and as Bitcoin does rally to probably around 15,000, expect me to start pushing our positions into smaller cap cryptocurrencies. So right now I like Bitcoin and Ethereum, but if we saw Bitcoin travel up towards 15K, I'd probably start rotating into the smaller cap cryptos. And again, it'll only be 2% of our portfolio no matter what. That's enough to get a good edge and generate some extra returns without risking a lot. Now, the trade I'm dying to do, and of course we've missed out over the last 2 years, is to short the Chinese currency. It's really a joke. They let money in, but they don't let money out. So there is so much money trapped in China, and they have this report with the errors and emissions of their currency showing up all around the world that they didn't account for. It's at record level right now. So nobody trusts the Chinese currency. And of course, they're willing to print money, devalue their currency to offset tariffs, to support different companies that are failing because of their government structure. Instead of just letting them go bankrupt, they're more concerned about keeping jobs. So they will devalue their currency before suffering the other problems, which would be a down stock market, which would kill their access to outside capital, or a slow GDP if they let these different businesses fail, which would result in unemployment. And again, that is their worst nightmare, is to have this 30 years of improving economic conditions start to fade away, which is already happening with inflation in food, and their wages are starting to really flatten out. Okay, we have Gold down a little bit, 1487. We're not playing spot, we're playing gold miners. So as long as that's a high price, gold miners can make a profit, and we're just getting started. So still like that position. Here's the 30-year German government bond. This is our best way to try to judge what's going on in China. If this chart is pointing down, their biggest trading partner, Germany and China, they're in trouble. And it's been heading down for a long time. Now we're having a little bounce here because of this potential trade deal, but I think the big picture is that China really has misallocated a lot of capital, and pretty much no matter what they do, at some point they're going to have to weed out all the misallocated capital and restructure their country to be efficient. And currently they're not efficient. They're just building shit everywhere at any cost to keep their GDP numbers up and keep outside capital flowing in. And so we've seen the U.S. Treasury 30-year, which best way to look at our TLT position, very closely mimicking the German bond. All right, guys, that's a wrap for today's update. We went for 50 minutes. Maybe tomorrow I'll talk about kind of the big picture, what may happen in the next decade or two. Just to summarize it, though, they're going to print their little hearts out until we get inflation, and then they're going to have to stop the quantitative easing, and they're going to have to start raising rates, and that's when our big picture view will start to dramatically change. Until then, this setup right here is very, very hard to beat, especially if you're looking for consistent returns and low volatility. Any questions out there from our live viewers? Yeah, Tencent alone has some 122 unicorns they own. Yeah, that's private equity valuation, so they can evaluate all they want until it hits the public market, and has lasted for a year. I wouldn't trust any of those valuations. All right, guys, give Dean a call. He's an expert options trader. He knows our system inside out. He can get you started. 505-322-7515. Really appreciate everybody. Tomorrow we'll trade the SPY, and Thursday we have our freebie webinar. Wednesday is our paid only webinar.